welcome. Thank you for joining us. It's really great to have you visit with us, and I'm sure our audience, as well as those online, will relishing the insights that you're going to deliver. Thea, you're closest to me, if I may call you Thea.
Yes, please.
The geopolitical environment. How do you think about it and its consequences for the region?
First of all, thank you very much for this invitation. It feels to me like I'm preaching to the converted already. It has been very enlightening so far. So, repeating the question, please, I didn't hear it clearly.
So, I'm clumsy. I should have just introduced and been a little bit more thorough. S&P Global, African Development Bank Group, Salvan offers yoga classes, is a fine chef, and is also the head of trading at Standard Bank as a night job. Thea, forgive me. With those introductions, just the geopolitical environment and how is S&P Global thinking about its impact, consequences for the region, for Sub-Saharan Africa?
Well, Gulam, I think you really highlighted it quite sufficiently during your introduction, and we very much agree. As you mentioned, the US playing a lesser important role to the overall region if you look at trade flows. But I think there's some certain risks on the horizon, and it's got to do with trade, financial flows, and then also the aid story, of course. So on the trade flows, upcoming risks coming up, 2nd of April, President Trump has been quite verbal about the reciprocal tariffs that he's considering, which is not just the sub-Saharan African story, of course, it's a global story, and we still need to understand what it's going to look like, what's the magnitude going to be. And then, of course, South Africans and the rest of the continent really wondering about ALGOA, the African Growth and Opportunity Act, which has to be renewed in September. We do think that the ALGOA will be renewed, but there could be a focus shift, probably more towards critical minerals. And there's, of course, the debate of there's some countries that could be excluded from ALGOA. There's, a lot of questions about that. And then the aid story, I think, also flows into the financial story. Some countries in sub-Saharan Africa are very vulnerable to less aid flows, some more than others, which holds implications for fiscal policy. And then on the financial side, we spoke about higher interest rates for longer in the US, in the European Union, and what that means for emerging market capital flows and capital flows to sub-Saharan Africa. So those are the kind of geopolitical factors we monitor at the moment.
Thea, as you were speaking, I'm reminded, AGOA was birthed as a unilateral engagement. In other words, the United States offered it to Africa without necessarily seeking reciprocity. Africa could export duty-free into the United States, but not necessarily have to prize open their markets for the US. And it's changed to now clearly America seeking reciprocity. Talking about that liberalization, with regard to some markets, notably Ghana, Nigeria, and Ethiopia, I've always been a proponent of the rule of law is foundational to economic advance, and the rule of law perhaps just falls within the broad thrust of reform agenda. Now, these three markets, Ghana, Nigeria, and Ethiopia, have injected a fair degree of reform impetus in recent quarters, and it comes with some pain, high inflation, high interest rates. Have these economies reached the zenith, the peak in terms of that pain point? And do you judge them as improving over the near to medium term and harnessing the benefits of those brave reform decisions?
Absolutely. Yeah, I think those countries like Nigeria, Ghana, Ethiopia really implemented very difficult policies. And I really think this has set the platform for sustainable macroeconomic growth going forward. And I think that's why we also quite upbeat about sub-Saharan Africa's growth prospects, because of these difficult macroeconomic policies that's been implemented that improve the inflation outlooks, the exchange rate outlook, and the hard currency availability outlook, which has been very problematic for these economies. Including South Africa, if you can see a rebound in South Africa and these large economies like Nigeria, we feel that we can remain positive about the outlook. But as I think the first speaker, highlighted, interest rates alone, hard currency availability alone does not set the road towards sustainable growth. You need those policy reforms that enhance your supply of your economy. South Africa is also a classical example of this. Interest rates alone doesn't bring, lower interest rates alone doesn't build bridges, enhance electricity provision, improve state efficiencies. Those things need to happen to really amplify the growth story in Africa. But I do think these difficult macroeconomic policies really set the scene for sustainable growth going into the next 5 years.
Thea, and not to dominate, and I'm going to come to our fellow panelists in a moment, but the thread of your conversations thus far has spoken to the underlying macro landscape, and ultimately there has got to be some impact on markets. And with respect to the Eurobond market, well, 2023 was certainly a drought improvement last year. What do you think is going to transpire with regard to the Eurobond market, with regard to the propensity for lending to the continent? Because that's really where the rubber hits the road in terms of the risk-taking, if conditions are going to improve or not.
Yeah. So, market access has been quite resilient. The first quarter of this year, the clever people tells me, portfolio flows remains resilient, but like you mentioned, there's risk factors on the horizon. And especially for those countries that are experiencing debt distress, with weaker economic fundamentals, the Europe and the US story is problematic. If you have higher interest rates for longer in the US, you have more difficult access to global financial markets for a lot of frontier markets, which is in sub-Saharan Africa. So it's very likely that you can see maybe, again, the dominance of multilateral institutions providing financing to sub-Saharan African countries during the course of 2025, a similar trend that what we've seen during the past 2 years.
Okay. Thea, thank you. Dr. Paul Mbuga, if I may also defer now to you. Again, welcome. It's good to have you visit with us. Dr. Mbuga, starting with the opening gambit, the geopolitical environment, and maybe with a particular reference to aid flows, which is significant for many nations with regard to, at the minimum, limiting the hardship and increasing poverty. And I'm mindful that during COVID-19, at least 40 million additional people fell into insecurity, food insecurity. How do you think about the geopolitical environment and the manner in which it's framing the continent's prospects?
Thank you so much, and panelists, thanks for being here, and really appreciate this conference by the Standard Bank. The trend we are in, we are seeing a number of geopolitical movements, and these have not happened only recently, but even last year, Germany, France, the US had a reduction in aid flows to the continent by up to $9 billion. And these are not small monies. Today we are seeing escalation in the geopolitical situation with the aid cuts to the continent, aid cuts to countries dependent on aid from the US. These have large implications, especially on the humanitarian situation. As you've highlighted, food insecurity, health infrastructure, health financing generally, the workers in the health sector, education sector is going to be largely impacted. Climate change financing is going to be impacted. Infrastructure financing, which we've highlighted, is going to be impacted by these aid flows, cuts in aid flows. And more so, the geopolitical tensions also take away attention from Africa. The Russia-Ukraine war, the war in Gaza, they tend to take attention away from Africa. But it is also a moment for Africa to reflect. Say, what can Africa do to guard against these tensions? They will continue coming. We have an opportunity. Improve governance, improve investment in infrastructure, improve investment in human capital, so that the impacts of these tensions, the impacts of actions outside will be minimal. We've seen minimal impacts, so for example, on COVID or the financial crisis of 2008, 2009, but this is largely because of Africa's limited integration into the international financial system, international trade. We account for only about 2.6% of global trade. And when issues happen at the global level, our impacts as a continent are limited, but not in a good way. It's because our contribution is weak, and we need to change that narrative. We can change it on the continent. These kinds of discussions, engaging the private sector, engaging policymakers, engaging financing institutions, is very, very critical. Thank you.
I'm mindful, as you were talking about our limited integration, 2.5% of global trade, yet we account for about 16, 17% of humanity. And the Caribbean, Latin America, they account for 6, 7% of global trade. So certainly we're clubbing below our potential, and potential may be rooted in increasing our presence in value chains. But I've been also probably guilty of this in describing the perilousness of the situation. What options does the continent have more full-fledged in terms of countering all of these potential headwinds?
The options are many. We need to do deep self-reflection as a continent, beginning with our leadership. We have many countries in Africa that make small arms, are engaged in tribal conflicts. But we have very few countries that engage in large manufacturing, pharmaceuticals, for example. And if there is something we should learn from the COVID pandemic, is that being prepared, having engagement with the global value chains, helps in situations of emergencies. We have only about 5 countries on the continent that are engaged in large pharmaceutical manufacturing, but pharmaceutical imports into Africa account for about 60–70% of our health care needs, inputs. Now, we need to invest more in infrastructure, like you indicated earlier, and all the discussions. This will help to create the enabling environment for investment, for private sector growth on the continent. We need to invest more in energy, the transformative power of energy in terms of enabling education to go on all the time, enabling private sector investment, processing, healthcare, technology advancement, etc., is unlimited. And this is something we need to take advantage of. We need to promote intra-Africa trade. As we speak now, intra-Africa trade accounts for only about 16% of sub-Saharan Africa's exports and imports combined. When we add on the informal intra-Africa trade, the percentage goes to about 40%. We can do a lot more, eliminating tariff barriers, eliminating non-tariff barriers, making the African continental free trade area a reality by actually making it work. There's nothing that stops South Africa, for example, exporting vehicles to the rest of East Africa, the rest of Central Africa. I come from Uganda, I live in Kenya. We import most of vehicles used in Uganda or Kenya, even Rwanda, from Japan, many miles further away. We could be importing from South Africa. South Africa is the biggest economy in the region, in Southern Africa. Is growing at only about 0.6, 0.7% last year and this year, the last 2 years. And this doesn't pull the rest of the continent, the rest of the countries in Africa into a higher growth. you mentioned the average growth for the continent at about 4%, but we could do more because we are coming from a low base. As a continent coming from a low base with a GDP of about only $3 trillion, we could grow at 7-8%. And we need to grow at 7-8% in order to double per capita GDP in the next 15 to 20 years. Continuing to grow at 1%, 2% means we'll need 30, 40 years ahead in order for us to double our GDP. There's a lot we can do.
Yeah.
We need to reorganize ourselves, continue these kinds of debates, and really mean a purpose for Africa. Thank you.
Dr. Mpuga, if I may just press you on the African Continental Free Trade Agreement. So much vaunted, a panacea for the continent, 47 or so countries have ratified. But I'm also mindful that when the business cycle abates, when economic hardship envelopes a particular market, the reflex of policymakers is to protect, is to look internally. And we saw this with Brazil, for example, just to use one country in the aftermath of President Lula's first term, internal strife, and suddenly relationships between Brazil and Africa began to recede following that really vibrant increase during President Lula's first term. And there's many examples around the world, so I'll cling to that suggestion. Are you not concerned now that there's sort of these perils, these headwinds, and the idea that growth could be slower, that policymakers assume a defensive posture that is in fact harmful, and the glacial movement with regard to the free trade agreement in fact is locked in as opposed to a greater liberalism that we require? And sorry, lengthy question, just we seem to be, is our ambition a bit too elevated? Should we rather looking for more strengthened regional relationships, a strengthened East Africa, a strengthened Southern Africa, with South Africa, big brother in the south, and West Africa nations establishing more vibrant corridors? Is that not more practical, more implementable, and still providing a level of celebration for cross-border activity?
True. And the defensive policies, the inward-looking policies, are actually harmful to the countries. The country implementing those policies and the neighboring countries. Before I moved to South Africa, I was in Ethiopia, and in 2021, we did a study on its capital controls. We realized that if Ethiopia could open up its financial sector, gradually remove the capital controls, it could add to its GDP growth up to 2 percentage points per annum for 10 years by opening up. And today they have started opening up. It's a gradual process. The pain you mentioned will continue a little bit, but with a gradual approach, it will open. Now, going to your question, indeed, looking at the regional subgroupings, it makes a strong foundation for the wider Africa continental open trade. Starting with, for example, the East African community, the Southern African Development Cooperation community, the West African community. Strengthening these blocks, and then now bringing the blocks together creates a greater foundation for greater regional integration of the continent. And this is what we need. Thank you.
Dr. Mpuga, thank you. Mr. Kisnasamy, you don't have the luxury of a long-range view. You're a markets practitioner. Volatility sometimes is your friend, and you don't sleep easy overnight. So how do you think about international developments and more immediate, prescient risk mitigation strategies?
Thank you, Gulam. Look, I think it's about making sense of the bigger puzzle that you see. And I think it's very important that you keep your eye out and understand what the big reset looks like, as you alluded to earlier, and what those big key structural changes are that the world is experiencing. And just to take a step back, I think that as we emerged from the throes of the pandemic, we understood that the world is going to be driven by scarcity and conflict. We expected the regional dominance to be exerted, as you alluded to, and we expected the financial metrics to drive the pace of that regional fragmentation. And we saw this manifest itself, as you alluded to earlier as well, in inflation, and inflation drove the nationalistic agendas that you experienced at the polls last year. So ultimately, countries have to grow themselves out of their issues, and this reset is looking, it's taking the shape of one of four things, or multiple things happening together. The US has to become more investment and net export driven as opposed to consumer focused, something that's previously relied on. China has to do the diametric opposite in order to succeed. Europe has to become more self-reliant, and Africa has to focus more on productivity as opposed to aid and concession. Those four factors shape the way in which we look at the way foreign direct investment and foreign portfolio investment is flowing. And we isolate a few key themes within that to give ourselves the comfort to navigate the daily volatility. Some of these themes, just as an example, we include US exceptionalism and the stronger dollar. Over time, there will be a need for a weaker dollar, but that's something that drives the way we focus our risk profile. Looking at China, for example, the impulse for lower rates, a bigger stock market effect to create wealth, absent the property market, and the need for the fortress balance sheet to prevent currency devaluations. That's a theme you can rely on. If you look closer to Europe, you can look at the recent developments in Germany, the fiscal and defense packages. Those are big themes that you can invest in both with respect to rates and growth, both in equity and debt. And as you look at what those global powers look to do, you can then cast your eye back to the continent and say, what does it mean for us? Energy, you touched on oil and the oil dependence. If you are able to get your head around the fact that the ultimate impulse for energy is going to be lower, what does this mean for Nigeria, Angola, and your oil-rich countries in terms of currencies, rates, expenditure, and investment? The infrastructure theme, large amounts of cash following specific investment. Those will create large revaluations in rates and different type of cycles attached to that. Commodities, non-oil commodities, the specific opportunities presented to manganese, cobalt, and other resources across DRC, Zambia, and Ghana, which we're seeing a lot of interest in currently. So if you understand where the money is flowing, you can always tilt your risk profile, take your clients to the right opportunities, and be quite confident in what you do, despite the daily inflection points that you see as policy, growth, and inflation changes. And if you ultimately have that North Star, you can create quite a unique mix of risk profiles that ultimately support your clients. And we look quite closely to what Thea and Paul discussed in the policy development space to strengthen those views and to ultimately lead us to opportunity.
Selvin, if I may, so you closed off by highlighting the linkage between policy and markets. And I think I try to also signal that the extent of forecast error in 2025 is amplified. And so there's perhaps a sense of polarity of outcomes. And you're probably thinking through the lens of scenario analysis. What is your thinking in that respect, and what scenario perhaps excites you the most or frightens you the most?
Interesting question. Look, there are a number of scenarios that as you can imagine, if you have growth, inflation, and policy interacting with each other, your scenarios are numerous. But we really look at four key scenarios from a markets perspective. As you saw last year, there was, and this is really the scenario one that we saw, you had what we would call, and sorry to use a trader term here, reflation. Ultimately, what that meant was that you were going to have higher rates, but you're going to have risk assets thrive despite those higher rates. And for Africa, provided the reform was happening in a good enough way, that risk appetite will filter into the likes of West and South and East Africa. And we saw that across Kenya, Nigeria, and South Africa specifically. Fast forward to this year, and the early part of this year, we see the growth scares come in as fiscal capacity eroded, and as the sentiment indicators around Trump tariffs started to take effect. As growth came in, scenario two emerged. And scenario two is really about what does the world look like in a growth-strained environment. And there we're seeing largely lower yields, lower appetite for risk markets, but importantly, lower energy prices starting to take shape. And you're seeing some of the fast money exit the likes of Nigeria, not in a material way. People are still confident about the reform, but you're starting to see how a lower growth environment can impact Africa. It's less impactful from a commodity space, and those countries generally remain quite strong. But the real question from here is where to next? And ultimately, that hinges on whether the US policy is going to be a one-off re-rating of the fiscal deficit from 6 to 3%. If that is the case, we see ourselves going back to that same scenario that you saw last year: higher rates, better risk asset prices. If not, your fear could materialize. We think it's a low probability event, but if the bigger than ever policies eat at growth, stagflation becomes a realistic outcome, and the interaction of energy, mineral resources, and more importantly, aid financing across the continent could create quite a unique challenge for us to face at a time when policy objectives are not that clear. So that explains it from a market point of view, and if I quickly may touch from a policy point of view, I think there's a few things we have to look at. Clarity on lending into arrears. How do we make sure that countries who face debt distress can recover from them quickly enough? Ghana still has to launch its bond, and that's an opportunity that we're looking towards. What is the US approach to multilateral institutions, and what's their support to that? And how do we treat some of the preferential status and sovereign credits? These are all issues we have to work through in order to make sure that we're prepared for the next crisis. But most importantly, in the previous crises that we experienced, there was always a solution. We knew it was quantitative easing before quantitative easing was about. We knew that fiscal dominance will exert itself in the previous crisis. Right now, we are not sure. We don't have the bazookas for the fiscal capacity. We have to work through our economies and create better accounting in order to make that happen. And we could face a world where interest rates are capped in the face of higher inflation if stagflation does present itself. And that will create a unique set of challenges that we've never seen before. Low probability, nothing to worry about just yet, but something that does concern me.
Selvin, to quote you, unique set of circumstances. So if the world is changing so fundamentally, are you altering your solution set? In other words, is there financial engineering? Is there novelty that is beginning to emerge in terms of providing our clients with solutions to navigate, to mitigate the current environment? Because I think you're kind of saying we can't also do different things with the same historical tool set.
Yes, definitely. I think you have to cast your eye back, and I've mentioned debt to GDP ratios. As the sovereign limits have been reached within various countries, you have to acknowledge that the role of private markets becomes very important as we navigate ourselves through our growth objectives. From a selfish banking perspective, management of our risk and our exposures to key countries becomes an imperative for us, especially if you consider the size of the infrastructure opportunity being somewhere between 100 to 270 billion rand. Dollars was, I think, the number that Luvuyo mentioned. So how are we able to transfer and manage and mitigate risk through the banking system with respect to that? And the development of our interbank repo markets across the continent, both as it relates to local economies and its interaction with offshore, is something that we have to focus on. As banks, we have to make sure that we can link our product and create as investment-grade-like products for the international markets to create and to fill those funding gaps that we see. We have to think about co-investment partnerships, both local and offshore, as we bring offshore skills to local skills in order to understand the opportunity and to bring down that cost of debt that Luvuyo alluded to earlier. And ultimately, we have to look at these tools in the pension fund space, the crafting of new or higher asset allocation mandates, specialized mandates in order to cater to the specific opportunities across debt and equity. And it's not really just about the clients, it's about regulators, banks, and clients coming together in order to create these new tools to sustain us to the challenges that we will face. There's one other additional factor, and that's the mindset. And I think the mindset in relation to debt as opposed to equity and other types of investment has to change. And if we really truly appreciate the value that our projects and our resources can offer to the continent, we're going to have to think about different ways about approaching investment that will yield benefits over the long term.
Selvin, thank you. We're almost drawing to a close. We have remaining minutes. I'm going to ask if it's okay, each of you, just your last minute parting shot, piece of advice that you would give to this audience. And I'm not necessarily going to say this to frame your responses, but it's astonishing when you wake up and you think that little South Africa has been parceled with Canada, Mexico, and China in the portfolio of Donald Trump's assailing. It just really alters your mindset of what is possible, but as I've suggested, these things have been trained. So just your final 1-minute remark, Thea, and guidance to the audience.
For me, I think it's really a question. You will see a bucket of investors that consider sub-Saharan Africa as a risk and those that see it as opportunity. And we are seeing emerging new investment partners from the GCC countries, Saudi Arabia, UAE in particular, India, who's really making use of the opportunity. So it's really about how you look at this continent through what lens. You will either see it as a risk or as an opportunity, and I think that divide is going to become much more clearer with the geopolitical developments we are seeing. But there are countries that are really stepping up, new investment partners who is not missing the opportunity.
I'm mindful of the recent IMF irritation at Abu Dhabi money flowing into Kenya. It was delightful to see. Paul, if I may, final remark?
I see Africa as a continent of large potential in terms of population numbers, in terms of land size. 60% of arable land globally is in Africa. And Africa is also a land of mixed challenges. We lack in skills, we lack in infrastructure, and it is up to us as a continent, with our leadership and the people, to invest in the enablers of growth, to attract investment onto the continent, and to promote growth, to promote trade, to promote real productive capacity in Africa. Thank you.
Selvin, I'm not going to ask you to answer those two questions, because as I looked at you, I just thought slightly differently. Juicy investment opportunities.
Look, we eagerly await Ghana to get back onto its bond issuance profile, because I think there's some unique opportunity to play to, specifically with respect to the commodity theme that we encountered. But maybe one other idea, and that's less continentally related, but it's gold that some of the traders referred to earlier. You know, you referred to the epochs, and way back in the day, gold was used as a tool to pay people in different countries when you went to war, and that's really its genesis for it being the crisis tool. And all you had to see was Russian reserves being frozen for you to know that the money can't be spent, and it's driving that key central bank that you're seeing, central bank buying that you're seeing as you look to diversify reserves. Whether you're an African country, an offshore country, I think the gold thesis is something that remains intact, and any country linked to basic commodity themes, their rates profile in the next complex looks pretty interesting to us.
Selvin, thank you. Ladies and gentlemen, Ms. Thea Fourie, S&P Global Market Intelligence, Head of Sub-Saharan Africa Economics, Insights, Risks. Dr. Paul Mpuga, Chief Country Economist, African Development Bank Group. Selvin, I fear sometimes, I worry when he opens his jacket, he's going to have a whole lot of items that's for sale.
I do have a few.
And he wouldn't surprise me, but he is our Head of Trading, Global Markets at the Standard Bank Group. Please indulge me and give them a rousing applause, and thank you.